Good morning, everyone, and thank you for joining us today for the Managed Account third quarter update. For those that don't know me or haven't spoken to me for a little while, my name's Jeremy Benson. I'm one of the advisor service directors here at Betashares. On the left of me, we have David Betashares, our Chief Economist and Head of the Investment Committee for our Managed Accounts. And joining us from his home studio, we have Cameron Gleeson, our Senior Investment Strategist and another member of the Managed Account Investment Committee. We thought we might sort of mix it up a little bit today for all of you, just to keep things fresh and exciting, and I guess continue to try and add as much value to yourselves and your practices. So we've brought Cam along to join Dave and myself just for another perspective on the model portfolios. Dave will kick us off initially running through what's happened in the markets over the last few months and the outlook moving forward, with Cam to join us to discuss more sort of, I guess, the intricacies with the portfolios and a bit of a deeper dive into some of the changes that we've made in recent times. Before I go on any further, however, I will just jump across to the next slide, just to remind you that anything discussed today is just general in nature. You'd all know this disclaimer pretty well by now, I would hope. Just a little bit of housekeeping. We are recording today's session, so if for whatever reason you're not able to make it through this sort of scheduled 45 minutes that we have, you will be emailed a recording of today's event shortly afterwards. And if you did want to ask any questions along the way, please feel free to. We do want to encourage that. Very open dialogue between ourselves today. We love audience interaction, particularly Dave, if anyone's got any hairy questions about what's happening in the economy at the moment. So there's just some instructions there in front of you for how to do so if you'd like to ask some questions. We actually have had a few sent through beforehand, so we'll do our best to get through all of those as well. Before I throw over to Dave to launch into his part, I do ask all of you a very quick favour, if you can. We're currently in the process of looking to launch a new risk profile for our managed accounts. We're looking at an all growth or 100% growth asset SMA that we're currently in the process of trying to get added to all the various platforms that you would all be using. So I'm sure I've spoken to a few of you about this over the last couple of months. What we're looking for is, and if you could please make a note of this, we don't need you to do this right this very second, but perhaps maybe if it's the first thing you can do once you jump off this webinar, if you're able to send through an email to your account manager with an expression of interest, if you would like to, or if you do see the potential benefit of an all growth SMA for any of your client base, if you could send us an email with your desired platform and potentially an estimated amount that you would be looking to invest over the next 12 months. We're looking to gather those, to take those to the platforms to make a case for adding these to the menus. Just very quickly, the all growth SMAs will simply look like our high growth managed accounts at the moment, the high growth risk profile being 90-10. We're just looking to drop the allocation to bonds and then pro rata that across the remaining, I guess, growth assets. So not drastically different to what you'd be currently using for clients at the moment. We definitely feel, and we're getting feedback from clients, that an all growth solution would be very beneficial for particularly younger accumulated clients, particularly on these new low cost menus that some of the platforms are coming out with. Or alternatively, if you have some desired or some favoured, I guess, defensive exposures in the fixed income, cash, term deposit space, an all growth SMA would allow you to blend in some of your favoured, I guess, defensive exposures to then set that risk profile the way you might like. So there's a couple of ways you could do that. So yeah, look, please, it would do us a great service if anyone listening today could help us out with something like that. All right, so now Dave, I might throw across to you to start here. Look, I'm going to jump in along the way and try and keep this conversational. I've got a few questions prepared. We've got a few that have come in beforehand. Where I'd like to start is we've obviously seen pretty interesting markets over the last 3 months since our last update. There was some crazy volatility maybe a month or two ago, if my memory serves me correctly. There's been, a lot of, I guess, eyeballs on inflation numbers out of the US, out of Australia. A bit of a tug of war between, are we going to see a soft landing or a hard landing, and what that means to markets moving forward. We also have, I guess, the US presidential election on the horizon as well. The models, the managed accounts have been positioned for a soft landing over, recent times. So I guess how's progress been going towards that soft landing in the last few months from what you've seen, Dave?
Thanks, Jeremy, and great to be with you all today. In terms of what is a soft landing? Firstly, it's the idea that, the high inflation that we got coming out of COVID can come down back to sort of pre-COVID levels without the need for the global economy, particularly the US economy, to go into recession. And historically, whenever we've had high inflation of the order that we had coming out of COVID, you've usually needed a recession to get inflation back down again. And that was my fear, or our fear, in 22 into 23. We switched to the view that it looks like inflation can come down without the economy needing to go into recession. Again, particularly the US economy. What does that mean? Is you can become more optimistic on the investment outlook, at least go to a market exposure to equities, and moving toward a good exposure to bonds as well. So the soft landing scenario is actually very positive for both bonds and equities, because you've got central banks being able to cut interest rates, which is good for fixed rate bonds, but it also means that the economy is holding up, corporate earnings are holding up, and equities can continue to move higher as well. So we've been positioning for that. We've been neutral in global equities. We've been overweight bonds. It served us pretty well. And just to sort of, as you can see here in the terms of the US situation at the moment, unemployment still pretty low, 4.2% in the US. So not a very big increase from where it got to, still close to 50-year lows, but inflation continuing to trend down. So that core underlying inflation measure in the United States, core consumption, private expenditure deflator down to 2.6%. So the soft landing scenario is still playing out. We'll touch on, we have made some changes to the portfolio going forward, but broadly, it is still consistent with this soft landing scenario playing out. There have been some fears. I mean, there was a couple of softish US employment reports back in late July. Markets are sort of fearing that maybe the Fed was too late in coming to cut interest rates. Maybe we were going to get that recession, if by accident. But a lot of the other indicators in the US economy are holding up pretty well. There's a thing called weekly jobless claims. We get a measure every week of the number of people applying for unemployment benefits at the state government level. Very good indicator of almost a real-time indicator of the health of the labour market, and they are still very low. They are like, rock bottom levels and have not really budged any higher. So I could go through a bunch of other stuff, but suffice to say, the economy is still holding up pretty well, and inflation is still coming down. And I mentioned this weekly jobless claims. This is the historical. Those dark grey lines, dark grey areas there are US periods of US recession. And you can see when that does start to spike higher, that's usually when the economy has gone into recession. At the moment, no signs of that spike higher, and still holding it at very low levels. So that is very encouraging for the economic outlook.
I might just jump in there very quickly, Dave. I think you mentioned it in the last quarterly report, and I know there's been a bit of talk about it since then. This touted SARM rule, I know that you've spoken to before.
Yep.
Which sort of feeds into what you've just mentioned. There was, I think, a bit of market volatility over the last couple of months once that rule was triggered.
Yes.
I guess, what are you saying sort of post that?
No worries. So just to go into that, I mean, so what is the SARM rule? The SARM rule is basically the observation, really, that every time the US unemployment rate, when you smooth it, use a 3-month moving average, every time that 3-month moving average unemployment rate has gone up by 0.5% from its 12-monthly low, it's not stopped there, and it's gone higher, and the economy is actually been very close to the month in which the economy's tipped into recession. So there were a few jitters in late July when the unemployment rate ticked up to 4.3%. And if you smooth it out 3 months, it's actually up 0.5% from its low, which is, I think, around about 3.5%, or on a 3-monthly average, 3.7%. So the SARM rule was triggered, but even the economist who discovered this, observation, Claudia Sahm, a US economist, said this time could be potentially different. I know you're always going to be careful when you say that, but one of the reasons the unemployment rate is going higher at the moment is not so much because demand is very weak and jobless claims are going up, as you see here. It's more so that labour supply is pretty strong. We're still getting a big rebound in immigration in the United States. We're getting labour force participation recovering from the COVID disruptions. And so employment growth and many other indicators are certainly at this stage a lot firmer than you'd usually see, than you've seen historically, a lot firmer than you'd seen historically when this SARM rule was triggered in the past. So that's why we're kind of discounting a little bit as a little bit of a different situation. Of course, we've got to keep watching it. We'll see if that unemployment rate will go higher. But just in the last month, it did tick back down to 4.2%. Jumping ahead of myself, but the Federal Reserve's own forecast that came out this week when they cut interest rates is that they see that unemployment rate ticking up to 4.4% by year end, but not a lot higher than where it is today. So, the Federal Reserve, we'll see whether they're right or wrong, but they don't envisage a big further increase in the unemployment rate. So again, just to summarize, yes, the SARM rule has been triggered. We've only just crossed that threshold, but we're not getting a lot of confirming other evidence in other indicators to the same degree of weakness as we've typically seen when that SARM rule has been triggered in the past. So our judgment is that we are not on the cusp of a recession, and so we have not, batten down the hatches accordingly.
All right, great. Thanks, Dave. Maybe this time will be different, as they say, and if it is, maybe we'll call it the Betashares rule. Dave, I guess following on from what you've just mentioned there, do you mind explaining to our listeners today, I guess, how this then plays into, maybe let's start with the defensive part of the managed account. So, how does this play into interest rates,
Sure,
into the Aussie dollar, and I guess any other sort of relevant metrics that you keep an eye on?
Just the last slide I wanted to just touch on here, just the Australian situation where unemployment's still also very low. It's been gradually moving higher as in the United States, so almost exactly the same sort of situation in terms of unemployment. The difference here is that inflation in Australia not moving down as convincingly as in the United States. It's still high-ish. You can see the monthly numbers. It did actually tick up the first half of the year. It's ticked back down again. But suffice to say, what that means for policy is that this is the market expectations for interest rates in both the US and Australia over the next year. So these are the market's expected level of the cash rate, and you can see the Fed funds rate is currently higher than in Australia. It was at 5.25. And the markets do expect, aggressive further rate cuts this year. The Fed, I'm sure as you know, cut rates by 0.5% this week, and the markets expect another 50 to 75, another 75 basis point rate cut over the rest of this year, and then maybe another full rate 100% next year. In Australia, the markets aren't really pricing in rate cuts this year, but more to kick in later. So yes, rate cuts in both countries, but the RBA lagging the Federal Reserve. Most importantly, what does this mean for bond markets and the defensive part of the portfolio? Rate cut cycles usually mean bond yields are heading lower. You can see there bond yields rarely bottom. It's hard to believe that bond yields won't go lower when we're only on the cusp of a rate cut cycle. You see that bond yields usually bottom some way through the rate cutting cycle, certainly not this early. So we do envisage further declines in bond yields, which will boost the value of fixed rate bonds, and hence you'd want to be at least market weight in bonds or strategic weight in bonds, if not overweight, which we have been up until recently, but we've also now gone overweight other areas like equities and gold, which has forced us to pare back our bond position. But we certainly don't dislike bonds. It's just we think there's better value in other parts of the market at the moment. But that's bonds, and you can see here the performance of one of the VBND is the Vanguard Global Bond ETF, which is part of our portfolio relative to our cash ETF, the AAA, and US 10-year bond yields. And basically, when bond yields are falling, you can see that it's the grey line on the right-hand axis. It's inverted. So when that grey line is rising, it means bond yields are falling, US 10-year bond yields. And fixed rate bonds, the VBND ETF, tends to outperform cash. And so that's played out more or less as we've anticipated. And a similar sort of story if you look at OZBD, the Australian fixed rate bond ETF, our fixed rate bond ETF relative to cash. Similarly, after some tricky, period of major bond underperformance through 22 and 23, bond yields are bottoming, have topped out and are starting to decline, and bonds have started to outperform. The other thing that's been happening, of course, is gold has been doing well. So QAU is our currency hedged gold ETF, which we can use in the portfolios. And a new update on the portfolios this quarter is that we have gone placed some of our defensive positioning in gold. And we think with bond yields falling, with the US dollar continuing to weaken, because the Fed will be aggressive, probably cutting rates more aggressively than certainly Australia and probably Europe and Japan, the US dollar should weaken. And those are favouring gold, and we expect that to continue. So we still like bonds, but we've put some of that exposure now into gold because you can't be overweight everything. And what we are underweight is cash. So we're underweight cash, and we're at least market weight or strategic weight bonds, and now a little bit overweight gold within the defensive part of the portfolio. The other element here is the Aussie dollar, we think, is going to continue to grind higher. Now, this is relevant when we consider where we've gone overweight in equities. But just in the interest of time, I won't go this through too much, but you can see the Aussie dollar is breaking. It's now knocking on the door of 68 cents. And the key driver there is not, and that's despite iron ore prices weakening. It's been that the US dollar has weakened globally, and so when that happens, the Aussie dollar tends to go up versus the US dollar. But also interest rate differentials, that is the Australian versus US 2-year bond yield differential. So our bond yields were once well below the US because we thought we'd be cutting rates to the same degree as the US would be, but you can see it's gone from -1 earlier this year to now back to flat. So that interest rate differential is narrowed, or our rates have gone up relative to the US, which is favouring Aussie dollar going higher as well.
It's actually very interesting there, Dave, that second panel on the top right there, just how, just how much that probably explains the direction of the Aussie to US dollar. If you look at the first panel, looking at when we were back at these sorts of differentials being flat, you can see the Aussie dollars probably back to where it was to US dollars a couple of years ago. So clearly a very strong driver for rates here, here versus the US. All right, great. Thanks, Dave. From there, I guess, how does this then flow into the growth component of the portfolios? I know you've just said we've taken a bit of an overweight to growth assets, or I think you've alluded to it. Would you like to, I guess, explain your thinking there at the moment?
So this is the MSCI All Country World Index. Just as a backdrop, you can see, we've had a few corrections, a few flutters along the way, but basically markets are still pushing higher and onto new record highs. And so the volatility of the last few months has sort of dissipated a little, and markets are now focusing on the Fed cutting rates, supporting the economy. And look, this is really important. The Fed are cutting rates. People, were fearing that the Fed would cut rates because of the economy tumbling into recession. It's not that they are very confident on the inflation outlook, and they are now providing insurance against a hard landing. So they're really trying to, provide insurance basically to the economy, really to try to support the economy. They don't think the economy needs to weaken any further than it has. And so that is very encouraging for markets, so much so that we have gone overweight equities, modestly overweight equities, because we think, with the Fed looking to support the economy and inflation coming down, they've gone a good way, but they can continue to go higher. And the key driver there will be just on the top right is earnings growth. It's continuing to rise. Earnings expectations for 25 and 26 are still quite bullish, and we expect earnings to keep growing. You can see the PE ratio there in the bottom left. It's basically close to its long range levels. So we think PE ratios from a global point of view are broadly fair. So maybe don't need to go a lot higher than where they are, but what can drive the market from here is continuing growth in corporate earnings. You can see here valuations, PE versus bond yields, and the equity risk premium versus bond yields. Look, maybe at the top end of their range, given where bond yields at the moment, but as bond yields fall, those valuations will I think, be supported. So we certainly don't see valuations at a point that causes us loss of sleep at the moment, but we think they're broadly okay.
I think, Dave, I'll just jump in there, just make a comment. Put simply, one for your clients, I suppose, as interest rates get cut, term deposits and bonds, the attractiveness of those fall, right, which encourages, I guess, market participants to allocate more to equities in search for higher returns.
Yep.
So I think, the simple logic there is as rates come down, as you expect, valuations and certainly markets should be well supported.
Yeah. So within the equity market, one of the things we focus on also is Australian versus global equity tilts. And this is just the relative performance of Australia versus the rest of the world. And really, just to summarize, we had the commodity boom of the noughties where Australia outperformed. And since the GFC, Australia's tended to underperform with the rise of the US tech companies in particular. So it's been a technology-driven market. It's not been a commodity-driven market. And barring the period of outperformance in early 22, brief period of outperformance when commodity prices went higher post Russia's invasion of Ukraine, Australia's tended to underperform again. So when we go overweight equities, we are placing it in global equities. We think this trend of outperformance of global equities is going to broadly continue.
And again, I might just quickly jump in there, Dave, as well. Just a reminder to everyone that our neutral asset allocation for global versus Aussie equities in the managed accounts is an overweight to global equities relative to Australia, right? Mm. That sits at, can you remind me, I think it's 60% global, 40% Aussie, right?
Yeah, so when we say, our strategic weight, our neutral strategic weight is 60% global equities, 40% Australian equities. And because we think we get better, it's not because we necessarily think over the long run global equities are going to do better than Australian equities. Our capital market assumptions are something like 8% return for both. But we just think global equities give you better, two reasons: better sector diversification. It's not all banks and miners. It gives you a good spread of other sectors, and plus it can offset some of the natural home country bias that investors may have in their other assets outside of the managed accounts. So, but it has served us well, certainly in the last few years, having that higher exposure to global equities. The last point I just make, and I'll leave hand over to Cameron after this, is just, again, the other kind of just information in terms of what's going on in equity markets. Not only is Australia tended to underperform, you've seen US markets outperform non-US markets, and that's being driven by the big tech companies. So it meant that if you look at the S&P in the bottom right there, S&P equal weight, which is part of our portfolio, just of late, it did underperform when those tech companies were continuing to do well. But there's a brief, I think there's a chance here that maybe we are starting to see a rotation, not so much from the US to non-US markets, but maybe a rotation within the US market from the large cap tech companies to some of the better value, or at least cheaper non-tech smaller companies, which would be an advantage to something like our S&P equal weight ETF. So we're watching that. Again, we don't tactically tilt necessarily within these areas, but it's just interesting that maybe we are starting to see a broadening of the US equity rally beyond the large cap tech to some of the smaller parts of the market as well. And you can see also global quality at the bottom. It's tended to do well. It's had a bit of a correction in terms of relative performance, but I think that is still going to. I think the trend there will be, I think, for continued good performance by quality companies, which again figure prominently in the smart beta ETFs in our portfolios.
Great, Dave. I think Cameron's probably got a few useful insights into some of those specific factor-based ETFs that you've just mentioned of ours that we use. For, I guess, anyone that's on this webinar, if you've been paying attention to our content on our website over the last couple of months, or you've come along to any of our advisor events, there's definitely been a lot of information put out from us on, I guess, some of the drivers behind the outperformance we're starting to see in some of these areas that you mentioned, such as the S&P 500 equal weight. So I'll let Cam touch on those a little bit more. Dave, thank you for all of that. Just having a look at a couple of questions that have come through. The first one, which is a pretty easy one before I throw it across to Cam, is, I guess, your expectations for the Aussie dollar moving forward over the next maybe 12 to 24 months. So obviously we've gone overweight hedged global equities. We're hedging our gold exposure, which I'll touch on a bit later. We haven't gone unhedged. So you've obviously got a view on this. Have you got any sort of firm ideas for where we might get to over the next year or so?
I think the Aussie could certainly break above 70 cents by early next year, maybe on the way to 75 cents. I mean, it was there only a few years ago. And again, just to sum, what happened is the Federal Reserve raised rates more aggressively than we did to deal with inflation. They went to 5.25, we went to 4.35. US dollar strengthened over that period, Aussie dollar weakened, and now we're reversing that. The Fed raised rates more aggressively, now they can cut rates more aggressively. As that renormalization process happens, US dollar can then weaken, Aussie dollar can strengthen, and I think that's really what's playing out at the moment.
All right, great. Thanks, Dave. That was the easy one. I've got a couple more challenging ones here. We'll see how you go. Just touching on the soft landing, or your position around a soft landing and the Fed and the RBA engineering one. There hasn't really been a historical precedent for a soft landing happening coming from these levels before, these high levels of inflation. What's giving you, I guess, the confidence or the view that this time might be different in that sense, and that I guess the central banks of the world might be able to engineer this?
Firstly, the evidence. I mean, the evidence is that inflation has already come down a long way with the economy holding up very well. I think we're compared to the 70s and 80s when we had high inflation, markets are just a lot more competitive. Globalization, tech disruption just mean that businesses can't maintain high prices and high margins. They can get competed away. And similarly, labor force is more competitive. The rates of unionization are less than they were back in the 70s. So there's less scope for that wage price spiral to build. But again, just from a macro perspective, and again, just to quickly summarize how I've seen COVID is, COVID was, the inflation came about because of shortages. Demand ran ahead of supply. Demand ran ahead of supply, and that's why prices went up, because we had to raise prices to ration the markets, and that's why corporate profits held up. I mean, if you're again, take Qantas, for example, if you've only got so many seats going to Europe, but everybody wants to go to Europe because they haven't gone for 3 years, you can jack up your prices, and so that's broadly sort of what we saw in many markets. But you know what? Supply has caught up. Supply has caught up. Demand, that initial post-COVID surge in demand moderated. Supply has caught up and prices have come back down again. So COVID, it was a different type of inflationary dynamic than what we've seen in prior cycles, and hence why, you know, this time, knock on wood, it potentially is potentially different.
Well, I'm certainly seeing a lot more toilet paper on the shelves of my local Woolworths, Dave. Right. So I'd say the supply response has definitely come back with a vengeance. And I guess, look, central banks, I guess responses this time around with firing up the printing presses is something I guess they've sort of shown they're maybe a bit more comfortable to do, you know, at the moment, you know, 40, 50 years on from previous sort of meltdowns we've seen in this regard, which leads me to my next question, which is something that then comes up a fair bit. The US has now a massive debt, you know, massive amount of debt, which they're paying a lot of interest on. Is there going to be a day of reckoning? How do they manage this? What does that mean for markets?
Will there be a day of reckoning? Unclear, unsure. Will they manage it? They won't manage it until there is a day of reckoning. So we're in this catch-22. The US government, neither Trump or Harris or any other US politician in Washington, will care about the budget deficit until the bond market cares about it. And the deficit has been allowed to blow out simply because the bond market has been able to well absorb the supply of treasuries. And, you know, politicians are going to keep spending money, going to keep cutting taxes until the markets don't allow them to do it. So the difficulty here is that we just never know exactly when or if that day will come for the US. But, you know, the reality at the moment is the budget deficit is running at, you know, 6% of GDP. Debt is on track to reach the even higher than World War II in a peacetime economy. So it is a pretty you know, unique situation. But you know, it's very hard to predict exactly when and if the markets are going to wake up one day and say, you know what, we've had enough. We're not going to take it anymore. We want higher bond yields to buy these treasuries, because so far at least they haven't done it. And those that have predicted this or anticipated it for the last, because this has been on, it's not overnight situation. It's been building for years and years and years. But you know, anyone who sold the market and feared a bond meltdown and a recession and all the bad things that would happen have been wrong. And I don't know when they're going to be right. That is the bottom line. So we just have to watch it and be prepared for when and if that happens.
Well, talking about wartime debt levels, wasn't there a debt cancellation or forgiveness across a lot of countries post the war? So maybe that's the way out moving forward. Everyone will just forget about it. But I mean, cutting interest rates, with the Fed cutting interest rates, that certainly helps ease the interest burden on their debt moving forward. So
the way the US dealt with it post World War II is they grew their way out of the problem, right? They we had a very good post-war economic recovery. The deficit went back from wartime levels. You know, the war was an exception, and so you know the deficit came back down again, and the GDP grew. So debt relative to GDP fell. But we don't have a war we're getting out of at the moment. So we've got a wartime deficit in peacetime, which is not great.
All right. Well, I guess that's probably one of the benefits of our managed accounts, that we've got yourself, Cam, and a number of other members on the investment committee constantly monitoring the situation for, I guess, if there are any cracks appearing. And I know you're always ready on standby to adjust the portfolios accordingly. So hopefully everyone feels nice and comfy and safe in your very experienced hands, and everyone's clients are sleeping well at night. Thank you, Dave. I guess if anyone has any more questions that comes to mind, feel free to send them through, and we'll do our best to get back to you, most likely after the webinar, but I think that sort of covers off on the main ones we've got. From here, I'll throw over to Cameron Gleeson, our Senior Investment Strategist and also another member of our IC, to discuss maybe some of the pieces of the managed accounts in a bit more detail. Cam, I've got a slide here which just very quickly summarises our special rebalance that we had maybe 2 months ago now in the managed accounts, where we updated the asset allocation or the strategic asset allocation to our models. It's nice to see that 2 months post rebalance, the portfolios have been doing particularly well. I was just having a look prior to this. Our growth portfolio, our 70-30 portfolio, is up about 4.5% in 2 months. So that's nice. Come on, guys. Hopefully we can keep that going for the remaining 10. But Cam, I'll throw over to you to talk a little bit more about this.
Yeah, thanks, JB. So I'll spend more time talking about how we're implementing the views that Dave talked about, and really sort of how some of this portfolio construction works, how we build portfolios using low cost and smart beta. Briefly, the changes we made in July were strategic asset allocation changes. We introduced a portion of our global equities as currency hedged. The reason we're able to do that is that we now have in HGBL shown there a very tax efficient ETF that can provide currency hedge exposure. Now, that's actually played out quite well in terms of the strength of the Australian dollar since the introduction of that fund. I should note that's not a tactical decision to allocate to currency hedging. That's a view that in the very long term, it makes sense for certainty of outcomes to have a portion of your portfolio currency hedged. We also introduced global infrastructure. We think that's going to be a really additive part of the portfolio over the long term in terms of diversification and returns. And we're able to bring in some Australian equity exposure, which is quality tilted in AQLT, so quality Australian equity. So that were the changes. We can obviously answer questions about them, but we did go through those changes at our last one of these. So briefly to highlight those dynamic tilts that we've implemented in the portfolios this time. Those changes are firstly, and I can sort of show the allocations or the tilts on a percentage basis on the right-hand side for the balanced portfolio. But if we just to summarize, the first is that, since the start of July, we've had increasing confidence that inflation is under control. We believe that the Fed is moving to the second part of its mandate, which is obviously concern, or I guess a focus on ensuring that unemployment stays at a healthy low level, and so far they've managed to do that. We see that the earnings growth in the US in particular has been strong. So it's really about seeing that soft landing play out, which has been Dave's central case for over a year now. But also looking at global equities versus Australian equities, we think that the earnings growth in particularly the United States supports equities in this soft landing environment. So having a higher allocation to currency hedge global equities, we think makes sense. And the way we've reflected this is to reduce our defensive tilt by 2.5%, you can see there. And we've added a exposure to growth assets in that currency hedge global exposure. And the final point there is that, the US dollar is now in play with the cutting going on in the US. That's created an environment where the Australian dollar can rally. It's also an environment where gold can outperform. And so, I guess there's an overarching theme in this sort of environment, cash is trash. So allocating to gold, we think makes sense, and allocating to currency hedge global equities makes sense. And where possible, we've taken that allocation from cash, depending on the risk profile. Just briefly to skip to the next slide, I think you'll receive these slides afterwards, but in sort of granular form, you can see the changes in weights across all the different risk profiles. So gold is represented in the last line within the defensive section. You can see the allocations and the changes to gold across that line. Within international equities, you'll see some percentage changes in those columns there. So for your own clients, if you wanted to look at what those particular changes were, if they weren't in the balanced allocation, if they were in, say, growth, you can look through and see how those changes play out for the different profiles. Maybe just to sort of reflect on the portfolio, and we do talk a bit about our philosophy and why we think it makes sense to use smart beta. And maybe to unpack some of the things that Dave said, actually, we talked a bit about the US equity market and the equal weight exposure to US equities. We use an equal weight S&P 500 ETF in QUS. We blend that with a broad market US equity exposure. So we're not entirely equal weight in US equities, but it's interesting to see how that market is playing out. This is showing performance back just over a year. We all know the story. US tech drove the broad market for a long period of time. So NASDAQ 100 shown in gray, the broad market shown in that sort of peach color in the middle. And then we started to see a bit of an interesting pivot. It's not that the US tech companies had a bad earnings season, it's just that they didn't continue to surprise in the upside to the degree they had before. And we can see that the NASDAQ hasn't really performed as strongly since that sort of late July period. And that's sort of held the US broad market exposure, the S&P 500, relatively flat. Whereas overall, you see that grindingly higher performance of equal weight. So equal weight US equities, that broadening out US equity market performance based on more of a macro driver, the soft landing, is really sort of playing out in the numbers that we see there.
Cam,
Maybe to move. Yeah,
I might just jump in there if you don't mind. Just again to remind everyone, the way that the managed accounts are structured is almost this core satellite kind of approach, right? You mentioned we use a low-cost S&P 500 style ETF for about 2/3 of our exposure to US equities, with around about 1/3 of that tilted towards the equal weight S&P 500 at the moment, for a number of reasons. And actually one that that we've been speaking to recently was the fact that with interest rates coming down, I guess that probably doesn't affect the large cap sort of tech companies as much. Is that fair to say, Cam?
Look, I mean, the US, tech companies are fundamentally right now being driven by earnings expectations and how the AI narrative is playing out. So yes, all equity markets are lifted in a soft landing, sort of scenario. But right now, their story is more about earnings. I mean, broadly speaking, what we are seeing is that the earnings growth in the US equity market is incredibly strong, and that extends to the full 500 stocks. The small cap stocks, the Russell 2000, their outlook perhaps looks a little bit more mixed. They're certainly riskier stocks, but what we see is a relatively healthy, collective of stocks within the 500 in entirety. And we think having some of that equal weight exposure certainly makes sense, because we know that there's a lot of concentration at the top end of the S&P 500. So that diversification, and we see this broadening out, which is what is actually playing out with that soft landing narrative, we think that's going to stand us in really good stead. Probably the other point, Jeremy, is if we go to the following slide, is to talk about, when we build these portfolios, we're never looking at, one fund in isolation. It's about how we blend smart beta funds, or if you like, factor exposures or style exposures to get better outcomes. And what blends really well with that US S&P 500 equal weight exposure is an exposure to quality. And this is an expression that we have through QLTY, a global quality leaders ETF. This is a very diversified exposure to quality. It doesn't have a massive weight to NVIDIA, which had ridiculous performance over the last sort of 15 months. But it's strongly outperformed MSCI World over that period. And so having some of that equal weight US exposure together with quality drives really strong results. And we think, as Dave mentioned, quality companies are still, it's a really attractive place to be invested, because while we think the soft landing is the most likely outcome, we still do ascribe a, relative, sizable probability to the chances of a hard landing. And having quality companies that have strong cash flows, if that adverse scenario plays out, certainly makes sense to us.
And I think from there, Cam, probably flows nicely then into a recent addition to the Australian equities sleeve, being our Australian quality ETF. So would you like to talk a little bit more about that?
Yeah, absolutely. So we saw with that previous slide the changes to our strategic asset allocation to add AQLT. So that's our Australian equities quality ETF. I show here the performance of A200, which is lowest cost broad market Australian equity exposure, QOZ, which is our, if you like, a dynamic tilt to value, which we've held in our managed accounts for a long time. That fund's outperformed the broad market since inception. But interestingly, over the last 2 or 3 months since we've added AQLT, QOZ has slightly underperformed the market. It has outperformed over the long term, but just over the last little while, it's slightly underperformed, whereas AQLT has certainly added value. And it's that combination of say, value and quality that's performed really well. Look, what's actually also quite interesting is there are a lot of active managers who are underweight CBA, and that's really cost them. Both of these funds have outperformed despite being quite underweight CBA, and they're just great building blocks to work with. So that sort of talks through some of the ways that we sort of look to build robust portfolios in equities. I do have another slide here just briefly, thanks for bringing that up, just to talk about smart beta and fixed income. And I'm sure you've heard Dave or Jeremy or Craig or others talk a bit about this, but the broad AusBond Composite Index, which is a very old index for Australian fixed income, has a degree of inefficiencies in that. And this, I think this slide really sort of shows that. There are various AusBond composite trackers, ETFs that you can buy. One is shown on the screen in grey. When we look to build our fixed income allocations within the models, we really want to be efficient. The blend we use for Australian fixed income is a blend of our floating rate notes issued by the large Australian banks, which is coupon. So that's a floating rate exposure, gives you a nice yield pickup, together with OZBD, which is our core composite bond fund. Both of these funds have outperformed the AusBond Composite over return periods, including those shown here, but together their outperformance is quite substantial. And we can see sort of the jaws, if you like, the difference in performance between an AusBond Composite Tracker fund, which tracks what we would describe as an inefficient index, versus a more effective way of approaching fixed income, using building blocks that are really built for purpose, built for investors, as opposed to just a measure of the broad market. And that's playing out really well and adding value to our portfolios.
I think just in the interest of time, we will wrap this up very soon, but I think I just wanted to maybe summarize those last couple of slides there, Cam, to again remind everyone that despite the extremely low cost of these managed accounts, quite often they can be looked at as very simplistic, passive index tracking in their approach. Hopefully what I guess Dave has shown and now Cam is that there is a lot going on beneath the surface here. We've got the quarterly dynamic management of the portfolios, with the asset allocation being looked at very closely. And then beneath that, despite the low costs of our portfolios, there is a lot of thought going into, well, how can we improve the outcomes both from a return and risk and diversification point of view without adding too much to portfolio costs versus just a low cost index exposure. So with that being the benchmark here in grey, showing you the AusBond Composite, as you point out, Cam. So I'd just like to remind everyone of that, because that is, I think, a really valuable point that you can discuss with your clients in your reviews.
This is probably worth talking about briefly here, Jeremy, is that the introduction of gold and our view that it's important, if you're holding gold, to have currency hedged exposure to gold. In other words, get exposure to the US dollar price of gold. Gold has performed very well over the last year, but in terms of our implementation, we use QAU, which is the only currency hedged exposure to the gold price. We see here the relationship between currency and in the US dollar index and the gold price. And clearly you see in periods of US dollar weakness, we tend to see that gold outperforms. So indeed, if we expect rate cuts to be more forthcoming from the Fed than the RBA, that signals US dollar weakness. In that case, you would like to hold currency hedge gold. Otherwise, having Australian dollar exposure to gold is going to mean that weakness in the US currency is going to offset a lot of your potential gains by holding gold. So really important to consider currency when you're looking to invest in gold there.
And our, for those maybe not overly familiar with our exposure there, Betashares offers the only currency hedged gold ETF in the market. The ETF code for that is QAU. The last time I think we actually had QAU in the portfolio was back around COVID 2020, where we saw the price of gold in US dollars go from about $1,400 an ounce to about $2,000 an ounce. So a return of about 30% in a 6-month period. It was, it was a crazy run in gold. What actually happened though as well with the currency through that time was the Aussie dollar appreciated about 30% against the US dollar over that 6 months. So if you're in an unhedged gold exposure, you could have got the call on gold right. The price has gone up 30%, but currency's wiped out all of your returns, where you wouldn't have actually made any money in that period had you been in an unhedged exposure. So I think that's probably a really key point to make, given everything that Dave said around expectations with the Aussie dollar and interest rates in the US, which is just something we can't communicate, I think, more, importantly enough. So yes, Cam, thank you for your insight there. Look, that brings us to a close today. I hope everyone's found this highly educational and useful for their clients. As a reminder, the quarterly report was sent around probably a week or two ago now. That is in your inbox. Feel free to reach out to your BDM if you've missed that and you need another copy. As always, thank you so much for your time and attendance this morning, and also for entrusting Dave, Cam, and the rest of the investment committee with, I guess, the management of your clients' hard-earned wealth. So thank you all for your support there, and we hope you do enjoy the rest of your day. Thank you.
Bye-bye.
Have a good day.